You wait all year, hit submit on your tax return, and there it is, an assessment of R0. Meanwhile, your coworker down the hall is bragging about a massive payout, one that's going to fund their entire December holiday. It feels like a penalty, but a tax refund is absolutely not an annual bonus or a reward from the government. Think of it like buying a coffee. If your total is 35 Rand and you hand over a 100 Rand note, the cashier gives you 65 Rand back. You overpaid for the drink, so they're simply returning your own change. When your tax assessment shows a 0, it means you handed over the exact change. You didn't make a mistake, and the revenue service didn't cheat you out of a payout. To understand exactly where your change went, we have to look at how your employer's payroll systems, your side income, and administrative rules dictate the final math. In South Africa, most of us operate under the pay-as-you-earn system, or PAYE. It's built to ensure you settle your tax bill in small chunks over the year, rather than facing a massive bill in February. By law, employers estimate your annual tax, deducting a portion from your salary monthly. If you contribute to medical aid, systems automatically calculate your tax credit, adjusting deductions in real time. Run perfectly over 12 months, the exact tax owed is collected by February. If you work a standard corporate job and get a 0 refund, your payroll department did their job flawlessly. But the perfect payroll equation breaks down as soon as you introduce outside variables. Freelance gigs, a weekend side hustle, or rental income, they all change the math. Even if you only have one job, employer-provided perks, what the law calls fringe benefits, like a travel allowance or the use of a company car, carry their own tax weight. The South African Revenue Service treats these perks as additional taxable income. This raises your overall tax ceiling far beyond what your standard monthly deductions covered. This diagram illustrates your tax profile as a balancing scale. When those new income blocks land on the scale, the tax owed on them actively consumes any potential refund generated by your retirement contributions or medical credits. Earning extra cash or enjoying corporate perks increases your liability enough to neutralize the standard deductions that usually generate a payout. Sometimes, the math actually says you are owed a payout, but the physical cash never arrives. Under the Tax Administration Act, SARS is legally permitted to freeze your refund if you have outstanding tax returns from previous years. Another common trigger? Unverified or outdated banking details. If they cannot confirm the account is yours, they hold the money. They also frequently hold funds at 0 pending an audit. If you claim significant medical or retirement expenses, the system requires supporting documentation. The payout stays locked until a human reviewer verifies the files. In these cases, the money rightfully belongs to you. It's simply sitting behind a temporary wall of necessary compliance checks. Let's rethink that initial sting of disappointment. Seeing a 0 tax assessment is actually a measurable financial victory. A massive refund means you gave the government an interest-free loan. They held on to your money for 12 months and didn't pay you a cent of interest for the privilege. Because people want that cash payout so badly, some resort to inventing fake deductions or hiding side income. That leads directly to severe penalties under tax law. A better strategy? Proactive compliance. Keep a physical or digital folder of your medical receipts and retirement certificates for 5 years. Having those ready means you can clear any SARS audit quickly. A 0 assessment proves total financial efficiency. It means you kept your cash in your own control, working for you month to month, rather than waiting a whole year for the government to hand it back.